Imagine standing inside a bank vault, watching a massive pile of cash suddenly vanish right before your eyes without a single alarm going off. No sirens, no guards running around, just total silence. Well, that is exactly what just happened in the digital world. A massive stash of 90 million XRP was completely drained from public crypto exchanges in a flash. It didn't get sold and it didn't get hacked. It just disappeared from visible order books. Where did all that supply go and why did it happen right now while the price is locked in a tight battleground? Something massive is brewing behind the scenes. And in this video, we are peeling back the layers on this hidden movement. We are breaking down the exact data floating around the crypto space, tracking where these millions of tokens went, and analyzing why the big players are changing the rules of the game right under our noses. Right? Now, let's start with our very first question about where did 90 million XRP disappear to? According to a highly discussed post shared on X right here by the prominent market analyst at Cheeky Crypto, 90 million XRP was abruptly pulled off public exchange reserves. Instead of sitting on public order books where anyone can buy or sell them, this massive volume of tokens was redirected into private custody channels, cold storage wallets, and over-the-counter desk, which we call OTC desk. In my opinion, when I see 90 million tokens exit public exchanges all at once, my trader instincts tell me one thing, and that's supply shock. This isn't retail investors moving 20 bucks to a ledger. This is a deliberate, coordinated drainage of liquidity. When supply on exchanges drops like a rock, it means there are fewer tokens available for the public to buy. So in my view, this is a massive long-term bullish signal because it shows that the entities holding these tokens have absolutely zero intention of selling them anytime soon. They are locking them away. So, why did large whale transactions drop by 57%? Right? Let's highlight this part. The post on X by Cheeky Crypto points out a fascinating contradiction in the data. While 90 million tokens vanish, on-chain analytics platform like Sentiment show that ultra-large transfers worth over $1 million, actually plunge by 57%. The numbers of these massive whale-sized transactions dropped from 157 down to just 67 in a very short period. In my opinion, on the surface, a 57% drop in whale transactions sounds scary. You might think the big players are leaving, but my personal take is completely the opposite. The whales aren't leaving. They are hiding. They are shifting their activity away from the public eye. They know that if they execute massive multi-million-dollar buy orders on the standard public exchanges like Binance or Coinbase, they will cause a massive price spike, making it more expensive for them to buy more. By lowering their public on-chain footprint, they can accumulate quietly without alerting the rest of the market. Now, our institutional participants using secret execution channels? The analysis shared by Checky Crypto suggests that institutional participants are heavily relying on private execution channels and OTC desks rather than using visible order books. So let's just highlight this part, right? Now, this trend is causing a massive divergence across different trading venues. For instance, Binance is showing a very high concentration of large transaction dominance, while Coinbase is seeing a lot more mid-size retail-heavy participation. Other major platforms like Kraken, Bybit, and Bedget are also experiencing shifting liquidity distributions as a result. Right? So let's just highlight this part. In my opinion, the hidden institutional migration to OTC desk confirms that I have believed for a long time. The big financial players are positioning themselves for something major. They are treating public exchanges like a distraction while doing the real heavy volume business in the shadows. So to me, this means the current exchange data we look at every day is only telling half the story. If institutions are actively bypassing public order books to accumulate XRP privately, it means they want to grab as much as they can before the public realizes how scarce the asset is actually becoming. Now, why is the price compressed in a tight range between $1.29 and $1.50? So let's highlight this part. Because of the massive shift in liquidity and the reduction of visible transaction flows, the XRP price action has been tightly consolidating within a strictly defined range between $1.29 and $1.50. The public order books are experiencing a form of artificial compression because the massive buying power is being handled off exchange. My opinion is that this consolidation range between $1.29 and $1.50 is a classic accumulation trap. It bores retail investors to tears. People look at the chart, see it bouncing sideways for days, get frustrated, and sell their bags to chase some random meme coin. But in my view, this sideways boring movement is exactly what the big players want. It allows them to maintain a stable price floor while they vacuum up the remaining supply. Smaller and mid-sized wallets are actually increasing their holdings during this boring phase, which shows that the smart retail traders are copying the whales and holding the line. Now, what happens when the Bollinger Bands face an extreme volatility squeeze? From a pure technical standpoint, the analysis notes that this lack of public transaction flow is causing a severe compression in market volatility. The price movement is getting narrower and narrower by the day. The post references a major technical concept, which is a classic volatility squeeze as described by the Bollinger Band. Right? Now, my opinion about this is that if you understand market structure, you know that extreme low volatility is always followed by extreme high volatility. Think of it like compressing a giant metal spring. The harder you press it down, the more energy it stores, and the more violent the explosion will be when you finally let it go. With 90 million tokens pulled off the market and the Bollinger Bands tightening to an absolute razor-thin margin, this compression phase is reaching an absolute limit. So in my view, we are sitting on a massive tinderbox. The range between $1.29 and $1.50 is about to break. And when it does, the directional expansion is going to catch a lot of breakout traders completely off guard. Now, how should we prepare for the upcoming volatility expansion? Right? The final takeaway from the data is that tracking exchange flows in private institutional channels has become the single most critical factor for interpreting where the market structure is heading next. So my game plan right now is to ignore the short-term noise and focus entirely on these liquidity macro trends. When the technical charts show a massive squeeze, and the fundamental data shows 90 million tokens vanishing into cold storage, the writing is on the wall. The market is being systematically cleared out of available supply. So I am watching the upper resistance boundary at $1.50 very closely. A decisive high volume breakout above that level could easily trigger a massive short squeeze and send us flying into the next major price tier. Overall, when you look at the entire picture, what we are witnessing right now is a massive coordinated structural shift in the XRP ecosystem. The sudden disappearance of 90 million XRP from public exchanges isn't a random event. It is a clear evidence of supply depletion. While public transaction numbers look lower on chain, the reality is that the volume has simply migrated to private institutional channels and OTC desks to prevent public price disruption. The current sideways consolidation between $1.29 and $1.50 combined with an intense Bollinger Band volatility squeeze tells us that the market is storing an immense amount of energy. The available supply on public trading venues is drying up fast, while mid-sized wallets and institutional players continue to quietly build their positions. So, do not let the boring price action fool you. The metrics show that the stage is being set for a massive liquidity shock, and tracking these hidden institutional flows will be the ultimate key to front-running the next explosive macro move. And this finally ends our video. Thank you very much for watching, and see ya on the next one, or you might as well check this recommended or suggested video right here.